What about the magnitude of the moves in these across the different parts of the yield curve? And, historically, we were in an environment where rates had been low. Yes, they had ticked up there for a while, kind of pre COVID, but just give people a sense of like the magnitude of these moves, how quick they're changing, just the shape of the curve, all this stuff, the way that it's happening, just in terms of basically the magnitude is the word I'm looking for, versus historically how these things move.
100%. Yeah. So the amplitude of these daily changes, right? The up, down, the daily fluctuations, the amplitude of that, it's historic. We've never seen anything like it. We've never seen several weeks back to back. And I try not to be hyperbolic, but in this case, it's fully warranted. The adjectives I'm using are not hyperbolic. This amplitude by which rates are moving up by 30 basis points on a day and then down 30 the following day and then up 15, then down 15, and then up 60 and down 60. You don't see that, right? The widest intraday moves you see in a normal market cycle on something like that's really actively traded, like a 2-year or a 10-year, are probably 10 to 15 basis points on a very highly actively traded day. Those are the kind of moves that you see. But we are in a completely different regime now. These moves are more volatile than Black Monday 1987. On Black Monday 1987, the 2-year yield fell by something like 67 basis points. 3 weeks ago, it fell by 81 basis points in a single day. And then throughout the week, it continued falling. And then it continued rising by equally large and very startling amounts. This is the type of bond volatility that explodes funds that aren't positioned for it. This is the type of bond volatility that leads to an even more immense credit contraction because people simply are not positioned to write loans using this kind of bond volatility. And it's certainly odd. And essentially what we're witnessing happening right now is a curve on inversion, and it's a very violent one. So basically, we've talked about yield curve inversion. It's been the talk of the town on financial Twitter and elsewhere around macro talking circles. And basically, the idea of curve inversion is along the yield curve, you should be compensated for investing your money in longer dated instruments, right? If you're investing your money in a 3-month bill, you should be compensated lower than if you were investing your money for a 30-year bond, right? It only makes sense, right? But when the yield curve inverts, the inverse is actually true, right? So you're actually getting paid less to hold your money on longer tenors, and you're getting paid more to hold your money on shorter tenors. And just from a purely mathematical standpoint, that's just basically the market saying we expect rates to be lower in the near future. And basically, the reason that this occurs is because there's some sort of policy error coming from the prevailing monetary authority. Remember, it tries to influence interest rates, and more often than not, it's very late to the party. And if it's trying to influence front-end interest rates well after the damage has already been done in terms of inflation, or in terms of sort of something else occurring in the economy, then you witness this yield curve inversion, right? It's basically investors piling into the long end over the front end, and that's really not supposed to happen. And every single time we witness an uninversion, right? So a return to normal of those conditions, basically what's occurring here is the front end of the curve, right? We'll call it, twos and below, is getting bid up more than the long end, right? So the shape is downward sloping when the curve is inverted, if you're plotting all of the tenors out along the x-axis. And now when the curve is uninverting, it's returning to a normal positively upward sloping shape. And the reason that's occurring is because people are piling into the front end more and more. Why are people piling into the front end more than the long end? Well, very, very simply, they expect rate cuts in the near future, and they feel that if these front end rates won't be around for much longer, right? They want to lock in a 4.5% 2-year Treasury note. They want to lock in a 4% 2-year Treasury note, and now a 3.5% Treasury note. The yield keeps going down because investors believe that if they don't buy it now, they won't have a chance to in the near future, right? And so essentially they are expecting rate cuts by piling into the front end more than the long end. And that's what's causing this uninversion. And each time this has occurred, right, why are investors doing this? Why do they expect front end rates won't be as high as they are in the near future? It's because they expect rate cuts. And so both the long end and the front end falling signal to us that not only are growth expectations falling, but because the front end is falling faster than the long end, it tells us that not only are growth expectations falling, but there will be cuts in order to re-stimulate growth on the other end. So that's basically what the yield curve is telling us.